Okay, here it is, the top of the hour. We want to be respectful of everyone's time. My name is Kristen Kolish. I'm joined by one of my partners, Chris Mahoney. We are financial advisors with Mahoney Group of Raymond James. And many of you who have joined tonight's program, we've known for many, many years. And we could not be more excited to be talking to you today. As you can imagine, there are a ton of things to talk about. We sent this invitation out only a couple of days ago, and we truly have had a tremendous response. And we've had a tremendous response from people of all walks of life, all different investment backgrounds, different life stages, folks who are early career, mid-career, pre-retirement, in retirement. And I think that that demonstrates how the news flow is making us feel a little on edge. If you're feeling exhausted over what's transpired over the last 6 weeks, let alone the last 7 days, you're not alone. So what we intend to do tonight is to start with a conversation of what has actually transpired, what's been the news, how have the markets reacted, and I'm going to do that. Then Chris is going to be talking about how that fits in the context of past sell-offs, because while the headlines might be different, the trends, the storyline that the markets can be extreme is not new, and it's something that we'll see in the future. And then we'll end with what we're calling our investor playbook on how you may be reacting to all of that.
Sounds good. Welcome, everyone, and thank you for joining tonight.
I know we've had lots of conversations, one-on-one conversations. The Mahoney Group, as you may know, works both with individuals and families, as well as employers and employees. So that's kind of a unique perspective, because we really do see the full gamut of getting people to and through retirement. And as part of that process, we view one of our primary responsibilities in many ways, Chris, right? Isn't it coaching?
Well, I think it is coaching. There's a field of study today, and it's called behavioral finance, and it's how people react to different stimulus. And certainly, what we've experienced the last 2 weeks or so is a heck of a lot of stimulus. And so, to the extent that we've been through this before, we'd like to share our experiences and some history, and hopefully that'll help you weather what we're going through better than if you hadn't heard this.
Yes, and the message that we'll leave here and then we'll wrap up with is we're a resource. So feel free to reach out. First and foremost, we want you to do no harm, but then also challenge you to think about your personal situations and look for opportunities. In fact, as we start to delve into the material, I'd ask you to be selfish. And what I mean by that is to think about the talking points that we have and what does it mean to you? What does it mean to your life? What does it mean to how you plan to spend the next 12 months? For many, I think while this news flow could be frustrating, perhaps terrifying, it may not have the same impact if you're thinking selfishly about what's the ultimate impact to you and your life. So I'll leave that as we transition into the first section. Chris and I are actually going to go off video because we have some slides with some dense information. So we want you to focus on the information, listen to our words. We are recording this program. It'll take a few days to get through compliance. We're happy to share it back out. We're also happy to share the slides. So please listen, take it all in, and would be an opportunity to follow up with questions as well.
Sounds good.
Great. So the first section, market update. I'm a big fan of framing conversations with quotes. And what I framed with the first section is you can't control the volatility of the markets. You can control the volatility of your actions. We can't control what others do. We can control how we react to what others do. In a lot of ways, that's a life lesson. What I think is so incredibly ironic is that almost to the day, 5 years ago, we hosted a very similar program. So think about that. That was March, April-ish of 2020. And we were in the midst of a crisis. It was a health pandemic that drove the markets and the economy to a halt. And the messaging around how investors should be thinking about that versus today's crisis there's parallels. So on the one hand, what I think is very interesting about 2020 and 2025 is that the headlines that drove the markets lower were actually not motivated by earnings or by the economy. Of course, there's trickle down effects, right? And the earnings and the economy are what we're going to talk about today. But back in 2020, it was a health pandemic. And in 2025, it was policy driven by politics. And the difference between the two environments is that in 2020, we were encouraged to be unified. The messaging, we're all in this together. And today, because a lot of the news flow and activity has to do with policy and politics, it does tend to be a little bit more divisive. It's just uncanny to me how there's parallels that are so similar to 2020, yet so different. But ultimately, investors are faced with the same challenge. There are things outside of our control, and what are we going to do with that information? How are we going to respond? And I think the saying, your perception determines your reality, for certain people, it comes down to risk tolerance and what is right for you and your family. So let's take a pause from 2025 for a second and just reflect on the last 5 years. I mentioned 2020, we were in the midst of a crisis. So you're probably thinking, Kristen, why were we up 18%? Stocks were up 18, bonds were up 7.5. Well, that was really a second half of 2020 picture, because from the end of February through mid-April, we saw the fastest decline in the market, the fastest decline in earnings in a 6-week period. And the government came in and provided stimulus, and we were able to rebound. 2021 continued the surge. And then in 2022, we had a sell-off that was driven by inflation. That's a word that keeps coming up. That inflationary environment and higher interest rates are what drove both stocks and bonds down during the same year. 2023 and 2024, the growth in those years were, the engine of that was really technology. So tech companies returned in 2023 over 50%, 50. And in 2024, we're also down, up over 30%. But optically, over a 5-year period, to have 4 really good years and 1 bad year, that doesn't sound so bad. I think most people would sign up for those types of returns. So for us to think of what the market's going to do in 25, put the headlines aside for a moment, to say that we're going to give back some of the growth of the tremendous growth of the last couple of years, I don't think would be a shock. I think what has been a shock is how volatile the markets have been on a day-to-day basis. And as you can appreciate, we've been preparing for this program this week. And as we were putting the slides together, I was working on it yesterday morning, and we had a graphic of what the S&P has been doing, and we storyline, and we're down 15% year to date. That was Tuesday going into Wednesday, and then there's a news headline that there's a pause to tariffs, and then the market spiked and increased 9.5% on Wednesday. So year to date through yesterday, we were actually only down 7%. So that's the type of volatility that investors are dealing with today. And, I'll give you a little glimpse into what we're going to recap with at the end in terms of strategy. Just like many aspects of your life, when so much is changing, sometimes the best course of action is not to react. And that's something that we'll end up talking a little bit more about. From a market risk perspective, I just want to define this for a second. Those who know us well know that we're always referencing and researching and following Warren Buffett. And one of the things that he talks about is what the definition of risk is, and the definition of losing in the market. And I think a lot of people, you may have even thought or verbalized, oh, I just lost 10% in my 401k, or I lost 12% in my taxable account. Well, I challenge you, because permanent loss of capital does not happen until you liquidate an investment. You still own the same number of shares of whatever stock, mutual fund index that you had prior to the valuation decline. The markets are saying, I'm going to give you less for that today. And the stock market and the bond markets are places where information is almost at an overload, overspeed. You certainly don't get the valuation of your home every day, or if you're a business owner, the valuation of your business. So the valuation of your portfolio, of your assets, really only matters if you're looking to sell, which is why your time horizon, which is what Chris is going to talk about in a few moments, is going to be so important. So forgive me, but I'm going to dive a little bit into the weeds here because I think that's what a lot of attendees tonight are looking for. If you were playing what we like to call buzzword bingo, and you were watching the news or listening to a podcast on current events, and you had the words tariff and deficit and inflation on your board, you would for sure be a winner, right? That seems to be dominating news flow. And there was grumblings about this ever since President Trump got into office, because you knew what his agenda was coming in. He was looking to shake things up, his administration, and that's really what's transpired. So going into this year, tariffs existed. It's not as if we were in a no tariff environment. In fact, the United States charge tariffs to the world on average of about 2.4%. And the rest of the world charged the United States about 4.6%. So when there was talk in the last couple of weeks of reciprocal tariffs, I think the market was expecting for the reciprocality to be our 2.4% going, or 2.4%, 2.5% going to 4.6. Some were saying, oh, it could get as high as 10%. Well, a week and a day ago today, as the media is calling Liberation Day, is when President Trump announced what the administration is calling reciprocal tariffs, but the numeric percentages were much, much higher than anyone was expecting. And that's really what shattered the markets. So let's step back for a minute. What is a tariff? A tariff is a tax, really, and it's motivated by a number of different reasons, which I'll get to in a moment. But let's just play out what's transpired. The tariff rates are being implemented with, or had been up until yesterday, with a formula that was very precise. And I think what surprised the market is that it was applied to every country on the globe. It was not just to certain trading partners. And the formula was taking a trade deficit. So let's define that. A trade deficit is when a country's imports exceed their exports, divided by the total amount of imports from that country. So there was actually the cover of the Wall Street Journal over the weekend had a news story about a very, very, very small country that many people have not heard of, that had tens of thousands of people, not millions, that were getting hit with huge tariffs because of this formula. So that's what the market was trying to digest. Monday, last Thursday, Friday, Monday, we had the worst sell-off in those 3 days that we've seen in decades. Lo and behold, yesterday, there's an announcement that there's a 90-day negotiation period where tariffs would be capped at 10%, with the exception of China, where there was going to be a tariff of 125%. And actually, I saw a headline coming into this program tonight that it could be as high as 134%. Now, we appreciate that many of you, as part of the registration process, did share some questions you had. So Chris and I, during our remarks, are going to try to sprinkle in those questions and answers as we go. And one of the very insightful questions was, what is the end game with this tariff story? And I'd like to lean on the motivation for charging tariffs. There's really 4 of them. The first is something called decoupling, and that's has to come down to supply chain. So actually, the sell-off in 2020 because of the COVID pandemic was a great illustration that there are certain goods we want to control the supply chain of. We want that to be domestic so that we don't have to rely upon others for that. That's called decoupling, and that's a supply chain shift. The second is something called rebalancing, and not portfolio rebalancing, but it's a rebalancing of imports and exports, where you're looking to increase domestic production because you want to reduce the trade deficit. The third is a negotiating tactic. It's to achieve a policy outcome. And in many ways, if that's your motivation, then the tariffs could in fact be temporary. And then the last is funding. So you might charge a tariff because that's revenue to your country. So revenue to help fund your budget. So ultimately, what's the motivation of the administration? I think, quite honestly, it's a little bit of all of this. And the negotiation that is being made very, very public is what is really jolting the markets. So I want to focus, I think what's really come to light in the last 48 hours is how this trade war that we were fearing was going to be global at the moment, and listen, what we know is what we don't know, right? Which is things can change, but it really has been very focused on China. And I came across this chart. It's actually from a website called The Visual Capitalist. They have lots of really interesting tidbits and information. And what this shows here is what the trading relationship looked like with the US and the rest of the world versus China. And you could see the blue color here is US as the larger trading partner with each of these countries. And the red countries is where China is the larger trading partner. So back in 2020, the United States trade was $2 trillion. China was at less than 500 billion. Fast forward 24 years, and the landscape has changed dramatically. So now you have US as a larger trading partner in a much smaller percentage of global countries. Our trade has, on an average annual basis, increased by about 4% a year. So now we're at over $5 trillion. But contrast that with China, where their average annual growth has been 11% a year, and their global trade exceeds the United States. It's actually at $6 trillion. So I think, they say a picture's worth 1,000 words. I think these two slides here really speaks to the motivation of current policy. So what does that mean to you and I? Yes, tariffs do pose an economic risk because if they are in place for a while, they're going to put pressure on earnings, on margins. Companies may be forced to raise consumer prices, or in effect, it's going to raise prices because the tariffs are almost like a tax. And those are real risks. However, if we've learned anything this week, we've learned that this is all about negotiation. This is a negotiation, and negotiations evolve over time. And we also know that corporations, both within this country and outside, are very good at adapting. The whole economic foundation of capitalism has companies that are looking to maximize earnings. And they can do that by driving revenue. They could do that by driving costs down lower. And there's this other variable, of course, which is that it's not just the administration's decision on things, that there are other stakeholders that could have a voice and could have an impact on the outcome here. So perhaps the Fed, if there is a slowdown because of these tariffs, or quite frankly, even if tariffs weren't the story, if there's a slowdown for any reason, and I think this is a very, very important point, recessions are not evil. Recessions are a part of a typical business cycle. Now, you may not like the cause of a recession for a whole variety of reasons, But the idea that earnings might slow or that economic growth might slow as well, growth or even decline a little bit, that has happened throughout centuries. And the Fed has been one of a number of sources of relief if and when it's necessary. Like the Fed, so right now, economists are trying to estimate what in fact is the projected Fed response to all this. Are they going to cut interest rates? If they cut interest rates, that could help the economy, that could help stimulate the economy. But they don't want to do that if in fact there's going to be inflationary pressures. Think back to 2022 where they actually had to increase rates. So they're taking a wait and see approach. Another really good question that we received was around what are the implications of these tariffs? And ultimately, the question becomes, how long are they going to be around and what is the impact? I'd say the two most important phrases on this page are corporate earnings and consumer spending. And one of the many good things that actually is existing in 2025 is that going into the second quarter, the economy was actually in decent shape. We got a really good jobs number last Friday. So most people in the United States who want to work are employed. The inflation rate has come down to a more manageable level, and corporate earnings have been strong. Now, tomorrow kicks off first quarter earnings season. So that's going to be what the market's really tracking closely. And what they're going to want to focus on is not actually what the earnings were last quarter. In fact, that's old news at this point. What the market wants to know is how are companies managing for the future? Are they, in fact, and this is the risk of the current rhetoric, are companies halting investment? Are they cutting capital expenditures? Are they pushing off decisions to hire? And I think there could be one of two things that happen. For one, worst case scenario would be if we see corporations during their earnings announcements guide lower, saying because of X, Y, and Z, we expect earnings to be lower in the future. The best case scenario, I think, or at least a better case, I should say, is that they say, you know what, this is a wait and see. We're going to see how it goes. We're not seeing anything today that causes us to cut, but we are going to react to data. We're going to react to the market as appropriate. So many of the questions we received, and I think some people think that we have a crystal ball, which of course we don't, but I understand the interest in this question, which is what are Raymond James's projections? What does Raymond James think is going to happen? We have huge teams of research analysts. We have a phenomenal political analyst, Ed Mills, who's been sending to the advisors daily, if not twice a day, communication. And in a call on Monday and reiterated yesterday, the analyst at Raymond James has said, you know what, we are cutting our earnings projections for the S&P 500. However, it's still higher than what it was last year. So what are they doing? They're saying, we think growth is going to be slower, but there's still going to be growth. If you were to poll the street, as they say, poll Wall Street, it's about a 50-50 probability of a recession. That's what we're hearing. And in terms of an S&P 500 target, because the question was asked, actually, the question that was asked was, what is Raymond James's best guess for what the S&P would be at the end of the year? And that's a good word because 110%, this is a guess. But based on their models and based on earnings, they're giving an S&P 500 level of 5,800, which is higher than where we are today, but ironically is about where we started the year. So the projections are for a flat 2025. From an employment picture, That's what's going to drive consumer spending. And before we start to talk about how this compares to past markets, I'll just remind you, if you may not know already, that 70% of US GDP, and GDP, of course, is gross domestic product. It's the economy. It's a measure of how economically progress we're making. 70% is driven by the consumer. And tariffs are considered to be a regressive tax because a greater percentage of income for the lower to middle income families are used up for purchasing goods. So we just want to keep an eye on what does that mean. Now, to date, up until this point, I've really just focused on tariffs. There's a whole other there's a ton of stuff that's going on in Washington. There's the budget reconciliation bill, which literally I got an email an hour ago with a recap on some announcements. So the government is aware of it and looking to provide stimulus in other ways to prevent that drain on the consumer. So with that, let me turn it over to Chris for some historical context.
Thanks, Kristen. So we talk about the markets and we talk about risk, and Kristen mentioned before or described volatility versus permanent loss of capital. And it really is an important distinction because volatility is about as normal as weather patterns. You know, it gets hot in the summer and gets cold in the winter. You don't know how hot or how cold, but it's really not a shock when it occurs. And that's the same thing with volatility. So some definitions: a pullback is described as a 5 to 10% decline in stock prices, S&P 500. A correction is 10 to 20%, and a bear market is 20% or greater. And this past week, at our lowest point, we were down 22.5%. So we definitely touched bear market territory. And honestly, with back-to-back years where markets were up over 25% and led by a narrow subset of companies, primarily the tech companies, the Magnificent Seven, who as a group were trading very rich, about 40, 50 times forward earnings, to anticipate that prices would be weaker or softer, did not take a Harvard graduate. And I just want to reiterate that from our perspective, and really from your perspective, when you think about the markets, most investors would be a lot better off if they kept this in mind. The market is here to serve you. You are not here to serve the market. So if market prices have declined like they have, it's either a good time to sit on your hands or try to take advantage of it. And now this slide sort of points this out. If we went back to 1980, all those red dots with the numbers, that's the intra-year decline or the final year decline. So you can see most recently in 2022, the market was down at 1.25%, but it closed down 19. But those red dots are intra-year. And what you would also see is that the average intra-year decline has been about 14%. And you know, we were down 22% earlier in the week and then bounced back, and we were down another 1,000 points today. So clearly a very volatile period, but really we've experienced this before. Not the reasons for it, but the activity of it. And if you think about that, here's a great example. If someone started off with $100,000 in the S&P 500 in January of 2007, and they went through the great financial crisis and they stayed invested, they had a very bumpy road, but their $100,000 grew to $590,000. If, on the other hand, the investor said, okay, I had $100,000 at the bottom in early 2009, I'm going to come out and I'm going to come back in about a year when things get better. That $100,000 grew to $384,000. And if they pulled out permanently, their $100,000 by January of 24 was $64,000. So really not such a great outcome. And during that period, we went through two recessions. We had the Great Recession, the financial crisis of '07 to '09. And then we had 2020, which was a very short-lived but pretty steep bear market, where stocks actually closed down or were down from February to April about 34%. And then that year rallied back and actually closed up 18. So trying to time the market is not such a great thing. And it's further illustrated here. This is all downturns and recoveries since 1926. And there's an old adage that we use, and we say it's long summers and short winters. And the reason we say that is if you look at downturns and you see the losses and the average length of time they were, and compare that to the recoveries have been much, much stronger, and they've lasted considerably longer. So staying invested is a big deal, providing you've updated your financial plan and you understand why you're investing in the first place. And I often ask investors when we meet their definition of investing, and what I typically hear is something to the extent that I invest to make money. I invest to get a higher return, and they're all great answers. But another answer that's equally great, and I think for most of our clients is really important, is investing at its essence is postponing consumption. So if you've got a portfolio and you're retired, you're going to consume that money over the rest of your life. And if you're a young person starting out and you're contributing to a 401k or a Roth 401k or IRA, you're placing money in with the idea that you're going to consume that when you stop working. It's going to help replace your paycheck. But it's a big deal because it puts things in a different context. And the context is this, is that I'm investing over time, for the future, not for tomorrow. So we think about crisis in the past, and we went back to 1970, and you can see the first one, that's the Arab oil embargo. And what's interesting is there's a little box right underneath, and it shows the duration of that downturn. And then you look at 1987, October 19th of 87, biggest one-day decline percentage-wise in stock prices, and how long it took to recover.
And actually,
And
Chris, if you were to see the cover of the Wall Street Journal today, there is a similar graph over the last 7 days. And
yeah,
to me, it looked almost like the Grand Canyon because it was so steep going down and then went up, a decent amount. But it's pretty uncanny when you kind of zoom out a little bit, how those sell-offs don't look as extreme.
yeah, and with the passage of time, they don't. But in the moment, it's gut wrenching. It's really scary. And honestly, the purpose of our program tonight is to try to give you some comfort and also to educate you to say, look, this has happened before, and we can pretty much promise you it's going to happen again. The reasons will be different, but how people react, how people think about it, that's human emotion, and that's pretty consistent. And you can see Kristen, if you go back to that one, the dot-com and banking crisis, really, that was the beginning of the decade, right? 2000 through 2009. And that was a pretty rough time. Yet, investors who maintain balanced portfolios, not just the S&P 500, broadly diversified balanced portfolios, had returns of 5-6% per annum through the decade.
Yeah, I remember in 2010, the cover of Time, right, it said the lost decade, but
Yep, the
not
lost
the case
decade.
for all
That's it.
investors. Yeah.
And this is another one. Look, if we went back the last 30 years, ending December 31st of 23, If an investor stayed invested with $10,000, it grew to $181,000. If they missed the 10 best days of that entire period, their 10,000 grew to 83. They missed the 20 best days, it grew to 47. And if they missed a month, 30 days, 29,000. 30 days out of 30 years. You think about that. So the idea that you stay invested when things are rough really makes a lot of sense. You look at this, the next one, Kristen. When do the best days in stock prices come? They come during crisis. And for instance, yesterday, the S&P 500 was up 9.5%. Out of all these recoveries that you see on the page, that would rank as the third best, right? 2008, October of 08, October 13th, October 28th, and then yesterday, April 9th. So these lousy periods produce oftentimes great single day returns. And that is the basis for the recovery, which we will have.
Yeah, why market timing is so difficult. You got to make two calls correctly, when to get out, but then when to get back in. And
Yep.
This type of environments, these stats here shows how difficult that is.
So you may not believe this, but market fluctuations or bear markets are actually your friend. They're not your enemy. So what we'd like to do, as I mentioned before, you'd rather profit from the folly rather than participate in it. We often say to investors, take what the markets offer you. And they offer something all the time. But you may feel this way. So, as markets accelerate and they go up, you're confident, I've made some money, this is great. Then, you really do well like we were. I think we peaked in this cycle February 13th, and it's euphoric. S&P reached an all-time high less than 2 months ago. And then we start to roll over, and we're sort of in this place now. We're nervous. What happened? It was so good 2 months ago. What's going on? And then as the market continues to decline, people get desperate and they sell. I can't afford to lose any more. And somewhere between desperate and defeated, there's an expression that you'll probably hear, and it's called capitulation. And that's when people throw in the towel. And for advisors like us, this is when we earn our money. We're really trying. It's really important for us to make sure that you're not overinvested in the first place, that there's a cash cushion or assets that we can tap during periods of market weakness. But keep in mind, if you've been with us the past couple of years, in 2023 and 2024, when we rebalanced your portfolio, we actually sold stock for most investors. And that's why we suggest diversifying your portfolio, continuing to invest during market weakness, invest for the rest of your life, and stay the course. Stick to your plan. So you think about how you do that. Well, what are you saving for? If it's to provide for your income now, great. What is the time horizon? How long does it have to last? Is it short or is it long term or both? What's the cost? How much does it cost to live? Is it just retirement? Is there a cash reserve? Are there other expenses like college? Are we managing debt? And are we concerned about wealth transfer? Those are all objectives that come up with us in our meetings with clients all the time. And then this, we often say matching assets to future liabilities and risk. So matching portfolio risk with timing of investment goals. And so what we mean by that is this, is if we have a cushion to cover expenses for the next couple of years through safe assets like cash and bonds, then if markets are involved in a prolonged downturn, we're not going to sell those assets. We want to keep those. But our asset allocation should reflect what we're going to spend, when we're going to spend money. So we think of it in terms of buckets. A short bucket, safe investments, 3 years and in. An intermediate bucket, somewhere between 3 years and 6 years, and a longer term bucket, longer, in excess of 6 years. That to us, in our minds, is a good way to manage risk inside clients' portfolios. So we think of near-term needs, intermediate needs, longer-term needs. Longer-term needs, and I understand the fear, but if you're a 70 or 75-year-old retiree, you may be drawing on your portfolio for another 15 or 20 years. And so to make an investment decision based on headlines today and news today, that'll probably change and probably will improve, seems kind of short-sighted. It may feel good, you've taken risk off, but in the long run, it's probably not helpful.
And this is a theme that we've been talking to investors about over the last couple of years, the fear that investors were starting to become complacent. I think that it's telling that we've had such a tremendous response to the program tonight. It's the market jolt has caught people's attention. And what we're going to talk about now are ways that you can think of the opportunities. So it's not just people who are in retirement that need to be concerned about this, but think about those who are still working and receiving an income. Perhaps those early in their career, whether it's you who's listening today, whether it's your child or your grandchild, in many ways, as you start out, your greatest asset is your ability to earn income. There's a financial planning theory, a visual that I can see in my head where it's comparing your human capital to your financial capital. And early on in your working years, your human capital is high, which gives you the comfort perhaps to take additional risks with your financial portfolio, which might be smaller. And then as your financial portfolio and capital grows, you want to think about how can I protect it? But that also begs the question, protect it from what, right? Are you protecting it from a decline? Well, if 100% your goal was not to decline, wouldn't be in stocks. But for most investors, the purpose of their portfolio is to maintain their lifestyle in retirement. Perhaps it's to fund an intermediate goal that needs, whether it's college planning or what have you, or maybe there's assets that'll be available to get passed on to future generations, all of which changes the definition of risk, right? Your risk is not that the portfolio is going to go down. Your risk is that you're going to need to spend it when the portfolio's down, which speaks to this visual right here. Know your cash flow. And as we get to the next point, we'll talk a little bit about diversification. But the cash flow, understanding cash flow, some would call this a budget, which is really, for a lot of people, a four-letter word. We see this all the time. The idea of understanding your cash flow is not just for people who are living paycheck to paycheck. It's owning where your money goes. And we're going to talk about thinking of your portfolio like a business owner. But to the extent that you can consider what are your expenses that are needs versus wants. And this has nothing to do with your income level. This is at all income levels. And you know what? Maybe of course, we want to make sure that you've got enough capital regardless of what's going on in the market for your needs. But if you have some other expenses, maybe you time them when the markets are agreeing with you.
So you think about diversification and when you ask most investors, do they think diversification is a good thing? Most would say yes. The problem with diversification is it works. And what I mean by that is diversification is about mitigating risk, risk defined as volatility. So simply put, if I had everything in the S&P 500, I've experienced a real roller coaster over the last 2 or 3 weeks. If I had half my money in the S&P 500 and the other half in treasuries, I had half the roller coaster, half the ride. And so you think about that and you say to yourself, as an investor, what could I do today? Well, you could sell all the stock out of your portfolio. You could do nothing. You could rebalance the portfolio and take money from safe assets and add it to risk assets. You could put cash that you've had on the sidelines to work, that is, invest in stock, and you could proactively add to risk assets. Those are all choices that investors have today. And so sometimes the best thing is to do nothing for some people. It's not the same answer for everyone. Everyone's different. But what diversification is an attempt to minimize volatility. And if you minimize volatility, it should help preserve your capital. And if you can preserve your capital, it should result in smoother returns. So again, I pointed back to 2000 to 2009, a very volatile period, a very rough period. The worst performing asset was the S&P 500 for that 10-year period. And yet, if you speak to investors today, there's a reluctancy to own foreign securities. There's a reluctancy to own smaller or mid-sized U.S. companies. And it's understandable because what has driven the market most recently are large tech companies. But at some point, and it may have begun, they will roll over. It doesn't mean you should abandon them. But if you're highly concentrated in a handful of names and that group goes out of favor, you're going to feel that harder. So again, it comes back to what is investing? Why am I investing? And if you're investing to support yourself and to consume money in the future, or your family is to consume money in the future, then diversification is something that you should probably take advantage of.
We appreciate that you've been listening to what can probably feel like a pretty dense topic for a good 48 minutes tonight. We thank you for your attention and your patience here. We're going to be wrapping up with the idea of viewing your finances like a business, whether it's how your employer views their finances during your working years, or the employer that you work for before retirement, whether you're a business owner and you're thinking about how you would manage your livelihood. There are some tenets that are a prism to make decisions, and the idea and the commonality is that we're trying to remove the emotional impact of decisions, which I want to acknowledge here is so very difficult. When it comes to investing, it doesn't feel good to see your balances decline, even though Chris and I are telling you you should get excited about it. You're probably thinking of these people are crazy. Why should I get excited about my balance going down? So I can appreciate that. But the work that you spend giving thought to the purpose of your investments, the why behind your assets, and the plan that you've put in place that has been stress tested and evaluated for what ifs the market goes down. Those are the things that you need to lean on. That's the process that you need to rely upon and the discipline that you need to follow. And I mentioned cash flow before. This is so important, understanding your cash flow from two perspectives. I mentioned the cash flow of your household, so knowing what are your cash outflows when it comes to expenses and owning them. I don't mean that to tell you that you should be restricting them. Just be intentional in where your cash is going. The second lens is understanding the cash flow off your portfolio. And there is a hidden benefit of stocks as an asset class that we haven't really touched on yet. And that's the idea that many stocks do, in fact, pay dividends. And, I've heard Chris talk about it as, what's the rent that you're getting on your portfolio? What is the cash flow, whether it's coupon income on bonds or whether it's dividends off of stock indexes or funds? What is that cash flow? And know that that's always going to be positive. So the value of your securities may fluctuate, but that's always going to be positive. And if we follow pretty closely dividend trends, the S&P 500 index over the last 50 years have had a compounded annual growth rate of 6%. That's really meaningful. And that's something that companies really don't want to cut. That was a concern during COVID, that there would be a lot of cuts, a lot of cutbacks. They were short-lived, if there were any. So understanding that that's a support that your portfolio has. So I'd ask two questions. One, for the portfolios that you're managing, when are you going to spend that money? And then the second is that, is the amount of risk you're taking today something you're comfortable with? Would you have an appetite for increasing it in the future? And there's plenty of people that are just such good savers that they're accumulating, and perhaps have not done as much investing. And I think that's something that the financial services industry kind of gets wrong, is conflating the two. Being a good saver and being a good investor is really two different things. However, you can be a good saver without being a good investor. You can't be a good investor without being a good saver, because you got no money to invest. So really owning that cash flow is hugely important. And if that's the case, is there opportunities for you to start to add into the market, viewing this as an opportunity? Now, I do not suggest, everyone's different, unique circumstances, so it warrants individual conversations. This is not market timing. That's not what we are trying to do. We just got done telling you that that doesn't work. But if you're looking to redeploy assets into a growth area, starting to do that during periods of weakness may not be a bad idea. Now, we did get some questions, and one of the points that one of our attendees was making is that, in a lot of ways, this quote unquote crisis is existing because outside of earnings, as we mentioned, in a recession, it's a result of announcements and decisions made that could be reversed. And that's what we've seen. So with such fluid news flow, you really don't want to be making wholesale changes to the strategies and the plans that you've put into place. This is an investment tenet that we've shared for years and years and years. And really, there's a corollary to where we started, which is we can't control the market. We can control our reaction to it. So when we react to it, let's dive a little deeper on the things you get to control. You get to control the amount of risk that you're taking in the portfolio. How much do you have in growth-oriented assets versus safe assets? What does your portfolio look like? Is it diversified? Are you aware of what the investment expenses are? Are you minimizing taxes? It's apropos, right? In case you haven't already filed your taxes, Monday's the day, so make sure that you're on that. But looking to be tax efficient, your cash flow, your spending, those are the things that ultimately we do get to control. We started out by making some comparisons to 2020 and 2025. What existed in 2020 is that interest rates were at near zero. So one of the things that savers have benefited from and are in a better position today is that you actually are getting paid to be in more conservative investments. So when you think about, if you could buy, one of the questions we received was, should I be buying treasuries? Well, if we go back to the bucket slide that Chris talked to, that could be an interesting solution for assets you're going to need to spend in the short term. Maybe, interest rates are volatile and they're changing, but, could you get 3 to 4%? In today's current environment? You can. So that's something that's a little bit different, and perhaps another strength that investors have. Sometimes I find that, and I'm actually going to turn my video back on as we're wrapping up. Sometimes we find that investors want to do something, right? There's so much chaos in the world. You just want to act. There's something you want to do. And the slide that we show here has to do not necessarily with investment or portfolio construction, but on financial planning fundamentals. And they're just food for thought as you think about, are there areas of your financial picture and financial life that you should give some extra thought to? And maybe it has to do with foundational items like cash flow. Maybe it has to do with taking risk off the table because as you're getting closer, either to retirement or in retirement, maybe it's communicating with your family about your estate plan and taking a closer look at getting organized with your finances. There are so many things that we could do to make progress in our financial lives. And these are all things that we get to control and that the market is not going to impact. And these are the things that matter. I mentioned in the beginning, be selfish. Be selfish by looking at these things and identifying areas where you can make progress.
Hey, Kristen, there was a few other questions that I think are still that we haven't addressed,
Yeah, great.
and maybe I'll take a stab at those. One of them was defensive strategies to limit the impact of market chaos. And simply put, I would say things to consider are asset allocation, diversification, rebalancing, and what you spend or what you save. So obviously, in market downturns like we're experiencing, if you can afford to save more or invest more, not a bad idea. Is this a good time to increase the contribution into my 401k, which has been invested majority of high and mid cap? I assume that to be large and mid cap stocks. Absolutely, but maybe spread that out a little more, include small cap and international stock. But absolutely a great time to increase contribution. How can I maximize my 401k currently seeing low returns? Precisely because you're seeing low returns is why you might want to increase those contributions. And then the last one was, I've been through two historic downturns with the Mahoney Group. At year end, what is the average rate of return on the S&P? Well, the average rate of return on the S&P over periods of time has been somewhere between 9 and 10%. And for us, balanced portfolios, which is not all, but the majority of what we run, when I say balanced, I say allocations, maybe 40 to 50% stock to 65 to 75% stock. Those returns in those portfolios have been mid to high single digits net of all investment costs. And we think that's a reasonable expectation going forward, simply because on risk-free assets today, as Kristen mentioned, treasury bills that pay 3 or 4%. Well, if you're going to invest in equity that has risk and the risk-free is 4%, your expectation for return should be obviously higher than that. But if you're willing to try to get a higher return, the price for that is added volatility. That's the trade-off an investor makes. So I would sum it up this way. Volatility is not pleasant. It's a lot easier for us to come to work when the markets are strong than it is like it is today. But this is when we make money. And so if you can persevere through this and take advantage of it, that's great. And if you can't, then hold on tight. We're going to get through this and we're going to be okay.
And
This too shall pass.
Absolutely. Great closing remarks, Chris. And if you're thinking about making a change, feel free to please reach out if there's stuff that you need to sometimes it just helps to have conversations. We do it internally all the time. So we are here as a resource. We appreciate your participation this evening and hang in there. Wish you the best.
We want you guys to be successful, and we're pretty confident we can make you successful or help you become successful. Please talk to us. You have any concerns, come to us. Thank you.
Thank you.